Hello, everyone. Welcome to another episode of GreenSky's podcast. This is our second episode focused on deeper tech investment. In this episode, we want to dive deeper into how at GreenSky we price risk when it comes to dealing with deeper tech companies and how we strike a deal with them. I have two of my colleagues and experts that we have on the GreenSky team, Valdis Martinsons and Neil Peet. I want to hand it off to you folks for a quick intro before diving deep. And Valdis, we can start with you.
Thank you, Moen. I'm a technology partner at GreenSky, having been with GreenSky nearly 10 years, been involved in every fund, and I've had a 35-year career in high tech through some of the big Canadian companies, namely Research in Motion, BlackBerry, ATI, which is AMD now, as well as Virgin Mobile Canada.
And I'm Neil, one of the partners here at GreenSky. Also been with the firm since the launch of Fund 1. And I do have a background in computer science, but it was back when HTML1 was released. So, enough to be dangerous, but also had a Microsoft certified hardware license. And I worked for a number of years as a strategy consultant, helping companies think sort of long-term, 30 years in the future. My role here at GreenSky is more focused on leads intake, evaluation, meeting startups, getting to know founders and some of the technologies they're working on, and then also providing really high quality mugs for demonstration during our calls.
Great, thank you, Neil. So I guess when we think about a venture capital deal, we essentially think in terms of risk and reward. When we value a company, obviously the higher risk the investment and the opportunity is, the lower is the value, and vice versa. When it comes to deeper tech companies, obviously one of the specific kind of indicators of a deep tech company is that there's technical risk associated with the deal. So because the technology is complex, because there's a lot of R&D that goes into it, the idea is that yes, if you have this product ready to go, everybody would love it, everybody wants it. But then the challenge is that yes, there's issues, or there are challenges, or there are risks associated with scaling up, fully developing the technology, and being able to get it to the hands of the customer. So Valdis, I'll start with you. When it comes to underwriting the technical risk, how we think about the risk when it comes to deep tech companies.
Thank you, Moen. So I think you got to separate the sort of our investments into two buckets, those that are hardware based and those that are software based. And the technical risks associated with each are very different. So starting on the hardware, when it's a hardware physical product, one of the things is to understand where in the product life cycle the development is, whether it's still in the lab, whether it's actually being used somewhere in the field, whether it's being hardened in the field, or whether it's actually being used in production or on an ongoing basis for mission critical use in the field. So so that's the first step, determining where it really is. Then determining how many devices have actually been produced, and not just prototypes, but actually products that are ready for commercial use. It's very different to have a prototype produced and say, oh yeah, we have these few more changes to make, and then we'll be ready for production, versus this is the final product that can be rolled out to production. People will actually use it, and it will be reliable when it's in the field. How much has it been tested? Has it been tested basically just in a lab environment, or has it actually been taken out in factory environments? Factory environments where there's mechanical noise, where there's electrical noise, where there's heat, where there may be all kinds of chemical issues, other factors involving that may affect the performance of the device. So where has it been tested? How extensively has it been tested? How many of those devices have been tested? How long the duration? Again, some things may work for a week, a day, a couple months. How extensively have they been in production use, in commercial use? How many devices in basically from the user side? There's different types of users when you roll out a device. Has it been rolled out by only technical people, and you basically need a lot of technical expertise to make it work, or can an average person make it work? that will play into the feasibility of actually the technical risk in actually rolling it out into successfully in many environments. So that's sort of on the hardware side. On the software side, it's a different aspect we got to look at. Okay, has the product itself been hardened? Are there bugs or issues that crop up when you run it day to day? Is the product itself to the point where you can actually self-serve deploy it, or do you have to go on site and actually install it? Where is it being installed? Is it just in the cloud, which is a lot easier to manage, or does it get installed on premises, which means you got to start dealing with all kinds of different environments where you're going to install the software and run into different issues that you may have because of the specific environments that you're installing it. If it's software also, how many transactions have you put through it? Have those transactions actually been production transactions end to end, or have you only simulated it? Have you actually load tested the software as you get into certain situations? It might be that you've only done 100 or 200 per hour or per minute or per day in the lab or in a controlled environment. Now when you're out in production world, it's a whole different world. They may be running thousands of transactions per minute. Also, if it's a multi-user or multi-tenant environment, there may be factors that affect it, that if one customer does one thing to it and another customer is trying to do something, will there be interactions and affecting each other, versus when you tested it or ran it yourself, it may be run in an environment where really you are controlling the load on it and the diversity of the load. So there's a lot of those kind of things we look at from the technical side to see where the product really is in the evolution and ready for commercialization, or where along the journey to full commercialization and scalability it really is.
Got it. Those are very, very important, valuable questions, I think, for founders when it comes to thinking about the technology that they're building. A lot of times when I talk to startup founders, they ask me, what are you looking for to make an investment? What actually, I guess, moves it forward for you? What is your team looking for to make an investment? Can you help us better understand a couple of milestones? And so when I think about that, I think of de-risking and like how we can actually de-risk the investment for the investor. And Neil, I want to ask you, what are some of the things that you think a deep tech founder look into? What are some of the milestones that they can think of? And obviously, depending on the stage of the investment when it comes to de-risking.
Yeah, it is one of those questions that obviously gets asked a lot, especially for founders. I mean, if you're also doing a lot of technical work, it's really nice to have very clearly defined milestones and metrics. Unfortunately, early stage investment, and especially pricing risk, it's still a bit more of an art than a science. But I would say that there's kind of two things to keep in mind. One, everybody always talks about traction, and I think traction is good, but what I'm looking for at an early stage, and again, at a late stage, it's growth, unit economics and gross margin, all that kind of stuff. But at an early stage, traction, what does it demonstrate? So if I sell one to a customer, that shows that somebody's willing to pay for it. That shows that there's some interest in kind of the solution that you've created. Hopefully, that also demonstrates technical validation. And so just to quickly bifurcate, traction on the technical side is great and important, but you should really be able to have moved past technical validation. A venture capital group, again, angels and early stage investors are maybe a little different here, especially government funding, but we're not really interested in helping fund R&D. That should be happening on an ongoing basis, but we're not really looking to do that. We're looking to help you now scale a business opportunity to grow and build something in the market. So traction should demonstrate that. There should be some showing or real world application of your technology in the market. Ideally, that should also be a conversion from a pilot to a paid rollout, because that shows that third party used it, validated the value, and is willing to now pay for it and roll that out. The second thing to think about is that's a big burden to lift as a startup founder. And often at the end of that, you feel like, yes, I'm ready. I know what I'm doing. I understand it. But much the same as it is when you're moving from sort of lab scale to bench scale to actual manufacturing scale, that next step is a big step as well. And so it's really helpful for us is, can you also demonstrate to me some of the potential problems and potential opportunities around sales, around rolling out, around that conversion from a pilot to a rollout, especially with if you're working with larger customers or sales channel partners or people who have to help integrate or install your solution. And so, the easiest way to do that is just say, oh no, I've done it 2 or 3 times, and here are the issues, right? I'm looking to raise capital to address those issues. That's obviously a best case scenario, but there are other ways to demonstrate those things. That's when a venture capital group, and certainly our venture capital group and our area of expertise, becomes really valuable to a founder, but also allows us to price risk better. The last thing that's really helpful as well is when you as a technical founder can help us to validate not just the technology, but also the protectability of that technology or the uniqueness of that technology. Is there IP? Where are you in that process? Maybe we can speak to your IP lawyers. Maybe there's patents that are already granted. Maybe you've gotten some initial feedback from from whichever jurisdiction that you're applying to, and we see enough of these that's actually really helpful to help walk us through, and then we can have a frank and open discussion about that risk. But yeah, being able to work with you to understand the protectability, but how to kind of validate some of that uniqueness or protectability is really helpful.
When I think about that de-risking, it's always this spectrum. One side you have like very protectable. There are patents. Nobody can copy it. And the patent is very strong because it's not just like a new method of doing the same thing. Everything is new, novel, etc. But then the quality of the patent can drop, the predictability can drop. There could be no patents, but data could be the kind of the moat. There are various levels of that predictability and moat. The same way that there are levels of third-party proof, there are like spectrum of traction that you can show. Obviously, one side it's like red hot risk, very very scary. One side is like cooler, like less risk. The closer you get to that cooler, less risk, it makes it easier for an investor to move forward on a deal. And so I guess speaking of a lot of red hot risks, Valdis, we talk to a lot of startups, especially we evaluate the technology together a lot. What are some of the red flags you're seeing? And again, this is one of the questions that I get all the time when I talk to entrepreneurs. They want to know, what are the red flags? What are the mistakes that other entrepreneurs make so that when it comes to them, they try to cover their bases?
So one of the things we find with a lot of the entrepreneurs, they're very good technically. They are science-based. They've come up with something, but many of them don't understand how you get the product to the next step. And the next step meaning, if you're actually going to scale this out, how you take it globally. If it's in the software realm, okay, in many cases, you're going to have the product supported and working and operational 24/7. Well, many of these people have invented something, but they've never thought about that. How do you actually provide worldwide support? In some cases, it's language. Some cases, it's time zone issues. Whereas if the product has to work 24/7, how do you actually roll out new upgrades? How do you actually roll out bug fixes? How do you actually do that in a staged way so that to the end customer, it's still running 24/7 versus what they've done when they've actually created the product, invented it, whether it's in the lab or the initial software versions, they could shut it down for hours to fix something or basically take it offline. There was no users. So transitioning from what I call the lab and you having full control and controllability to when the product is available to actually having it available all the time. Similarly, hardware. If it's a hardware product and you've now rolled it out to various jurisdictions, how do you support it remotely when some of it could be in Europe, some of it could be Asia, wherever you're rolling it out, even across North America? There are different requirements for certain things in different jurisdictions on what you can actually run or what you have to support. One of the things also founders often lack what I call understanding of the deployment process and operational side of things. So they've come up with something, but how do you actually test it on an ongoing basis? How do you build a process that does regression testing if it's software, so that you're not reintroducing bugs that used to be there, you fix them, and with a later version you reintroduce it? So how do you actually roll that out? How do you actually separate the developers and the techie, what I call the deep tech people who actually have developed the product, from the operational people who actually day to day have to support it, and making sure that when it gets put out there, it can be supported. And there's various models, and perhaps in a different episode we'll talk about that, but various models on how you do that. And then there's even the third party dependencies. A lot of people don't understand they've incorporated various components in their software or hardware. Some of it may be freeware, some of it may be licensed. What happens if those integrations or those components or some aspect changes? How do you actually add the new components or incorporate them and make sure you test them again, put them through the full process instead of just deploy it and hope that it works? Integrations are the classic. We've seen that many times where a lot of people have integrated to a third-party product. All of a sudden, the APIs or something changes and the product no longer works. The customer no longer really gets any value out of whatever the entrepreneurs are selling. So how do you actually make sure you work closely with the integrators? And in some cases, it's about deployment partners. Many of the different companies we work with, they're not the end they're not the end ones who support the product to the customer. They use third parties, integrators, whoever will actually end up selling the product. Well, who's going to support it when it's deployed? Who is on the hook for what? And what are the responsibilities to make sure they're very clear who is responsible for what aspect? So those are some of the red flags that, okay, has the entrepreneur ever even thought of those? Have they considered it? Do they have a plan to addressing those and hiring people to actually add to the team to be able to add the right bench strength to be able to successfully do that?
Thank you. So we talked about pricing risk. We talked about the technical risk, underwriting the technical risk, red flags that we see, and some of the milestones that founders can think of when it comes to de-risking their technology. But then ultimately, as Neil, you mentioned as well, we have to get to that art piece of things, which is like really putting a price and like putting things into a term sheet and sharing that with the company. We've had 3 episodes focused on term sheets. So what goes to term sheets? We've had James Brink and Mark Shushin talk about term sheets and different aspects of it. But what I wanted to ask you was just diving deeper into like putting together the term sheet, that process, and again, maybe walk us through, if you have any example in mind, how we price it, how we do the initial negotiation, and what are some of the templates that we use to do that.
Yeah, good points. I mean, I'm not going to dive a lot into, or I don't think it's worthwhile to try and rehash, pref shares and this and that, because as you said, we've gone into more detail. I also strongly encourage founders to take a look at some of the standard documentation out there, and not to say that it's the best thing ever, but standard documentation is standard for a reason, and these are the kind of things that will give you a bit of a sense of what's market and not market. Often we hear founders kind of talking to sort of advisors, and unless you're actively working in this space all the time, you might be getting advice that may or may not be aligned with what's market. And so as a founder, that can be, can waste your time. It can be misleading. It can be dangerous even coming into a conversation with a VC where, as a founder, you know your tech, your customers, your market better than ever I ever will. But presumably I do investments a lot, and so I should know a lot about the investments. So when you're sort of telling me a bunch of things that you believe to be true that aren't, it can create some problems. So my suggestion is the North American Venture Capital Association, or even Techstars or these other groups, they have kind of these standard documents they share. In Canada, we have something called the CVCA, the Canadian Venture Capital Association. On their website, they'll have some standard docs for venture level docs. So now you're looking at kind of late stage seed, which is where GreenSky plays, sort of writing $1 to $2 million checks, all the way up to Series A, Series B, and then some convertible note examples as well. So those give you, as a founder, a bit of an understanding of here's what and again, they're very long. they're trying to cover all the bases, which is fine. But to put it in perspective, our term sheet used to be, like 3 pages long. But we also now use these standard documents because it just gives everybody a good place to start and to at least start at an equal footing, and then to discuss what might be different in this particular deal. With that being said, what I always like to tell founders is at GreenSky, we're not looking to financially engineer a result. So all the stuff you hear about term sheets, and there's different terms, and there's a lot of complexities you can add to any deal. If I'm investing in a company, I'm looking to invest, as you've heard a lot about, in a good team, a good technology, and a good market opportunity. If those things actually happen and play out, even, not even 100% of our expectations, even 50% of our expectations, we're all going to be happy. If I have to spend all my time on the term sheet trying to financially engineer a result in the next year or two and do that to the detriment of the founders and the detriment of everyone else, right? That's not actually going to benefit me or anyone else in the ecosystem. And so GreenSky's approach, our thought process is really, let's both be happy or both be unhappy, but at least we're both on the same page when we're entering into this relationship. And part of the way we do that is we say, you as a founder are going to understand the opportunity, right? You know your market, you know your tech, you know your customers. So tell me about that opportunity. Almost price that opportunity, price that upside. Oh, it's worth this much. It's going to be amazing. And then, obviously bring that back to today. You're not pricing yourself in the future. So you bring that back today, but give me the really the positive case, the exciting case. And then I'm going to tell you, as we've talked a bit about here on this podcast, some of the risks. And I'm going to tell you, these are some of the things that I would price. And if we can have that conversation and realize, hey, we're actually really not that far apart, and there's somewhere in the middle that we're probably going to end up both be, as I said, either comfortable or both uncomfortable. As long as we're both on the same page and are willing to work within those parameters, that is going to be the start of a productive conversation. The second thing that I would add is GreenSky likes to do that early in the process. So, yes, we want to understand you, we want to understand the technology, all the things we've talked about, but me spending 3 months doing that or 2 months doing that is not going to make me more of an expert than you. I'm not going to be able to tell you the value of your technology better than you should know it based on what's happening in the market, what's happening with your peers, etc. So that's why I'm sort of letting you price that upside. But if I can understand what you're trying to do, and I can understand some of the risks that are present in what you're trying to accomplish, we should be able to have that conversation early on in the process. Again, this is our perspective. That way we at least know where we're going. I don't want to spend a month or 2 months with you and then realize you were hoping for a $50 million valuation and I'm kind of looking at a $5 million valuation. Well, we're never going to meet in the middle. So I would say, that's kind of, it can feel a little uncomfortable having that conversation early, but my recommendation to founders is you should have a bit of a range that you're excited about, somewhere in this range. Yeah, this makes sense based on what you know. You should have a bit of an understanding of what sort of the basic terms mean, pref shares and common shares, and what a standard document might look like. That way, if you have to have that conversation earlier on in the process, you can, and then you can at least get a pretty clear sense from your potential investment partner of where they're going. The last thing we like to do, and this is, again, our GreenSky recommendation, is the more you add to the deal or the term sheet, the more complexity you introduce, the more complicated it makes all your future fundraisers. So again, we like to keep it simple, keep it unencumbered, because often as a founder, you're trying to solve problems, and that's great. But adding a bunch of milestones and tranches and trying to finagle your way to a higher valuation may in fact hurt you in the long term. And so our recommendation is usually, let's talk about how we can work as partners. And again, if we invest, we're going to be partners. So, we may be sitting on opposite sides of the table today, but tomorrow we're going to be sitting on the same side. So let's look at some of those risks that I see and some of the opportunities you see. And if we can figure out, again, how to get comfortable together on approaching those things and evaluating those things, we can then price that, as opposed to trying to structure a deal that can take all those things into consideration. So those are the three things. GreenSky likes to kind of keep it simple. Let's do this early on in the process. And then last but not least, we kind of have to work together to get on the same page again. Whether it's both unhappy or happy, we should be on the same page.
Great. And so maybe to wrap it up as kind of a bonus case study, Valdis, it would be great if you can share a successful story that we've had at GreenSky.
So, yeah, we had invested in Rank Software, and Rank had gone to various different funding sources, and we heard from them initially that none of the funding sources really understood what their product was, how it would actually change the risk profile for enterprises, etc. So when we met with Rank, I sat down with the technical founders to understand really what the product did. And Rank was a company that had needed substantial operational experience in actually scaling the product, but in evaluating the product to understand what they really did, somebody needed to understand the telecom world. And I'd come from the telecom world, so I understood the intricacies of what they're actually trying to do and how they're doing it. So what their product really did was they, any enterprises, and it was mainly targeted at larger enterprises, it would basically eliminate or notify the company of any imminent threats from the internet. So their technology that they developed, and this is a mouthful and I'll break it down after, it was deep packet inspection for enterprise networks in real time using a realistic amount of computing resources with minimal degradation in corporate network performance. So that's really what they did in a nutshell. So breaking it down, they actually had software that went in and looked at all the communications that was coming into the network, as well as in certain points within the network was actually going across the network. So they were targeting where, their first target was really telcos, and they had a customer, a big customer in Europe, telecom company. And what they did is actually be able to pick off any threats, imminent threats. They could actually park or shut down those uh, communication flows, or actually park that information so that it would basically be neutralized or sterilized, you could call it, and no longer would be a threat to the company. Or if it really was a big issue, they could actually block all communications to that network and isolate and insulate them from that imminent threat. So when we went and evaluated it and talked to the founders, the technology guys, we were the first ones who they said actually understood what their product did, what the value that their product brought to the world, and that we'd be a perfect partner investing in them. And in the end, you can tell the story of how successful the company was and how we exited at a great value.
Great. Thank you so much, Valdis, for sharing that. Thank you, Neil, for also sharing a lot of the interesting experience that you've gained over the years dealing with deep tech startups. And I think that brings us to the end of these two episodes focused on deep tech companies, tech kind of risk evaluation and pricing to risk. I guess stick around for future episodes.
Thanks, Moen. Really appreciate it.
Thank you, Moen.